What's up, YouTube fam? Welcome back to the channel. In this video, we're going to talk about the option selling strategy that'll help you print the most money while ideally mitigating risk. Now, I know this is going to be a risky strategy to some, but if you're someone who, doesn't have hundreds of thousands of dollars in capital and wants to start making, income that you think can potentially supplement a job or make you, some good side hustle money, side income money, then this is the type of strategy you're going to have to enact, right? And just to show, we started documenting this channel. It was November 6th, right? We could pull up the date. So since November 6th that we started this, we've been able to grow it in 25 days about 16%. So obviously it has required some capital to get there. $20,000 is what I started with. You could definitely start with less, but I think 20K is the perfect amount to try this type of strategy. But you can definitely do it with 10, depending on which stocks you're going to do. Some of the stocks I did, you wouldn't have been able to do with 10. But anyway, let's get into the strategy, right? So when it comes to option selling, the thing you're doing is you're collecting premium, right? So you sell an option and then you buy it back for less. So when you wait for an option to expire, right, assuming it expires out of the money, then it's worth zero. So at that point, obviously you collect the premium and then, you're not assigned. Now, if it expires in the money, you will still collect the premium, but you have to buy the shares, right? So you're getting what's called assigned. Now, in this case, obviously it's a Sunday, so I can't do anything right now. But being that it's worth $4.05 and I sold it for $6.50, the way it works is at any moment you can buy it back for the difference, right? So you don't have to wait until the option expires. You can collect your profit early. Obviously, again, I can't do it right now, but tomorrow morning, assuming it goes down more and I decide I want to collect profit, then I could. So that's the first thing, right? And that's kind of like the basic of selling options. Now, the first thing we're going to do is we're going to sell puts, right? Because a lot of people, they only talk about selling covered calls. The problem with selling covered calls is you have to buy the shares first. The difference with selling puts is that you don't buy the shares unless it expires below your strike price. So if we look at the play that we're in currently, right, on MSTX, the only way we're buying the shares is if when Friday comes around, it is below $75. Now, I don't intend to hold this all the way to Friday, so I'm going to explain to you the strategy that I'll be doing throughout this week and what I've been doing over the last month to get the results I've gotten. But that's just the basic of how it works. So again, I opened this play when MSTX was at 100. So it's basically at exactly where it was when I opened the play. But when I first got in, as you see, it fell all the way down to 75. Now, had I been in covered calls and owned the shares, that would have been a lot of money that I would have been down. But since I was selling puts, I really wasn't down anything. And of course, at this moment, it's the same concept. I'm really just up money, and I can close this position today or tomorrow for $500 profit. Assuming tomorrow will probably be more. By the time the market opens, data will kick in, and these premiums will go down more. But ultimately, the first two things I wanted to discuss were selling puts as opposed to covered calls, and trying to go after volatile stocks. Now, when it comes to volatile stocks, obviously something like MSTX is going to be extremely volatile as it's a 2x. It's basically MicroStrategy, but a 2x leverage fund, so it's going to be extremely volatile. MicroStrategy is obviously very volatile as well, but the difference is it's 387 a share, which means you would have to have 38,000 in the account to sell puts on it, right? Now, if you're someone who doesn't want to get involved in 2x leverage, here's what we do. What we do is we look at the earnings calendar, right? It's always good to find stocks that you know are going to have big news because that creates the implied volatility spike. And what that does is it allows the premiums to jack up. So the thing that's on my watch list, or the two stocks that are on my watch list for this week, one of them is being Chewy, the other one's being DocuSign. So being that both Chewy and DocuSign have earnings this week, let's look at these premiums, right? So if we were to look at Chewy premiums a week ago, right, they would not even be close to these prices. But since they have earnings this week, right, that is why these premiums are way higher at the moment. Now, obviously, we're still in this MSTX play. So the idea is going to be basically the way it works is the premiums will be very high up until earnings. So that means Monday and Tuesday, they still will be just as high because data won't be, the problem is until the news comes out, the premiums will stay jacked up, right? So after the earnings comes out, then they'll shoot down. The good thing about playing earnings is one, if it shoots your way, then chances are these puts will go to zero immediately. So if you sell it, you can collect profit that day. Two is even if the market goes down, since the IV shoots down, or sorry, since the IV spike has already happened, these premiums don't really move that great in the favor of buyers. So basically when you're selling options on a stock that has earnings, it's either going to go the way you want it to, and then you'll be able to collect all the profit immediately. Or if it's going to go against you, you're still going to have a lot of range of motion, we can call it, because of the way that the premiums will move. So with my account size, hypothetically, right, look at this. We're in the position where we can collect, let's just say 20, we can use 21,000, collect 760. Now, again, keep in mind, I'm still in this MSTX play. So the plan is going to be, right, assuming Monday and Tuesday, it doesn't go down too much, what will happen is data here will eat away at these premiums, right, 88 cents a day. Ideally gets down to like $2, which allows us to collect another, another 400 or so. So we can collect 900. Then we take this play on Chewy, right, which would again allow us to collect 700 or so dollars, right? Now again, we can go even lower, right? We could go 30 and let's see, collect 400, right? Or, maybe even 500. Now we can go 30.5 and collect 600, right? So I'd probably go a little lower just to be safer. So let's just say by Tuesday, we decide to close the MSTX play, collect 800, right? Then take this play, collect 530, right? While being pretty safe, right? And the reason why we know it's going to be pretty safe is one is because Chewy is a relatively safe stock, right? And that's the most important thing when it comes to selling options, right? Is making sure you're doing it on safe stocks. So let's go into Chewy and let's just look at their previous earnings reports just to be extra cautious. Let's see, will it show us here? Okay, boom. So look at this. They've beaten earnings 1, 2, 3, 4, 5, 6, 7, 8, right? So 7 out of the last 8 they've beaten earnings. And obviously there's been great news with Ryan Cohen, the CEO. There's just been a lot of good things around Chewy. Chewy is the type of company that I think we all believe in, right? We all believe is going to be around for a while. And obviously it's had its moments where it's been up a lot, came all the way down. Now it's been trending back up. So there's a lot of good things about Chewy. We can go into their financial reports. I'm not going to start reading them on this video. But ultimately, they're a stock that, if worst case we were stuck holding, it wouldn't be the end of the world, right? Now, with that being said, again, the plan is going to be to take Chewy options. Now, I'm probably going to go 30 and be a little safer. Now, how do we know this is a relatively safe strike? We know it because when we look at the ATR, so the ATR, what it means is the average true range of Chewy is going to be $3.33 on any given week. So being that's at $33.41, if we take the 30, that puts it all the way out of the ATR. Now, again, with earnings, it can easily go past it. But typically speaking, if it does go past it, it will come back relatively quickly because that's what the ATR does. And I'm sure anyone who's been trading for a while or watching stocks knows, no stock just goes straight up or straight down, right? Every single stock always eventually retraces and moves back. Now, if you've been following this channel, you've noticed a lot of times I take half ATR. So if we go half ATR on 31.5, we're in a position to collect a lot more premium. So I haven't decided. Maybe I will do that. Maybe I won't. Maybe I'll do one of these two. I don't know yet. We're going to have to see how the stock opens on Monday, first of all. And I don't intend to take the play really until Tuesday and then ride it. And then ideally, right? So hypothetically, if Chewy does go in our favor after earnings, right? And these premiums jack down. So let's say we got in at $1, 7 of them for 700. And let's say it goes all the way down to like 30 cents, right? So that would be 7 times 7 or 70 times 7, which would make us up 500, right? At that point, we would take the 500, close out that position and take DocuSign, right? Why DocuSign? Because again, DocuSign also has earnings this week, right? Where is it? Right there, Thursday. So ideally, what we do is we ride with MSTX from Monday to Tuesday, close it Tuesday, take Chewy on Wednesday. Ideally, it goes our way, close it Thursday, or even we could even probably close it at some point Wednesday, take this, and then if we look at the premiums on DocuSign, you'll see that they also are extremely jacked up. And again, I'm not just making this up. If you're watching this, go look at the premiums next week after earnings. You'll see they're going to be, minuscule prices. But again, looking at our amount in this account, we could take a strike like this that's relatively far. We like to keep it above 30 delta, but since the earnings are coming out, we can go below 30 delta. Now, if we keep it in the 30 delta range, right, again, we would collect 570. So ideally, we collect another 400 this week off MSTX, another 400 or 500 off Chewy, and then another 400 or 500 off DocuSign, which would give us a $1,500 week on this $23,000 account. So 1,500 of 23,000. Percentage-wise, that's like 6-7% in a single week. Now, I know those are high returns. Obviously, to get those types of returns, you're going to have to take on some risk. Now, with that being said, since we're selling cash secured puts on stocks that have had good earnings reports, high market caps, that's how we're mitigating the risk while, it's like mitigating while maximizing risk, right? Because if we went straight into covered calls, we'd have to buy the stock. If we just bought the stock, it would be the same concept, right? Since it's selling puts, what you're doing is you're giving yourself all of that room, right? So let's just say if we do sell the 30 puts on Chewy this week, and we do it for 700 shares, that's giving us $2,100 in losses that we wouldn't be taking as if we just bought the stock, right? That's giving us 9% of leeway. Okay, so again, if we just bought the stock right now and it dumps 10%, we'd be down $2,000. But since we're selling puts, we're giving ourselves 10% in buffer. And again, if you look at all these charts, yes, there's bear trends, of course, but no stock just moves straight up or straight down. So when you're doing something like cash secured puts, you're giving yourself an optimal entry. You're giving yourself an optimal point where even if you do get stuck getting assigned and having to buy, chances are it shouldn't take so long for it to at least come right back above your entry, and ultimately you can get out for a profit, right? Because we're not here to marry stocks. We're not here to be long-term investors. With MSTX, since it's a 2x leverage, it's even crazier, right? Like if you look at my strike, it's currently 23%. I think it's even higher, honestly. I think we'd have to go on a lower time frame to see that. Let's see. Yeah, 27% away, which I know people in the comments have said, and I agree with them, I should have went even further, being that the risk of this stock. But that's kind of the essence of the strategy, right? Is we're looking for high volatility stocks. We're looking for stocks with earnings, stocks that have a reason for the premiums to be jacked up. And let's look at one stock I've been looking at. I haven't taken any action with, but it's ACHR. I saw that big hedge funds are just starting to get involved in it. As you see, it's been skyrocketing lately. And due to the volatility, right, the premiums are extremely high. For a $9 stock, to see premiums at these prices is just absurd, right? Like let's see, how many can we even do? It's like, again, we can collect 750 based on our account size. It would require us to sell 3,000 shares. But the point is, we're here to collect juicy premiums, make the most money, while mitigating risk at the same time. Now, this stock is crazy, right? Do I recommend getting involved in it? Not really. But, if you're looking for something with high premiums, high volatility, that's what you have to do. You have to go after either stocks that are extremely volatile or stocks that you trust but have big news coming out, something like earnings, behind it, because that's what's going to cause the premiums to jack up. Now, if you follow some of these other YouTubers that do option selling, a lot of them are taking safer stocks that are less volatile. And yes, if you have hundreds of thousands or millions of dollars, then why would you take this type of risk? Maybe for a small percent of your portfolio. But if you're someone like me who's playing with 10, 20,000 and you want to sell options and do it in, the least risky way, in my opinion, while also getting the highest potential returns, this is how you're going to do it. So I hope you enjoyed this video. I hope you learned a lot. I hope you take in this strategy and use it. I'm not going to tell you which exact stocks you should do it for. I'm just going to tell you what I've been doing and what I'll continue to do. And make sure to continue to follow the journey. I'll be dropping videos, as much as possible, so you guys can keep seeing everything, right? If you go back to the first episode, you'll see where this account started. And if you watch every single episode on this channel, you'll see literally every single move of how we've gotten this far. I've documented every single trade, and I plan on continuing to do that. So I hope you guys, again, learned a lot, enjoyed this video. Don't take too much risk, but take just enough to make some money. Hope you've had a great weekend, a great holiday weekend, and I'll see you guys tomorrow for the update and the next video.